all I'm saying is, if there's a big market kerfuffle, I think they're going to throw even more money on it, and that's game on for monetary metals anyway. If there's no market kerfuffle, what's going on is already inflationary, and that's maybe not as dramatic, but still very bullish for monetary metals or safe haven assets anyway. So either way, I'm very bullish on gold and silver.
I think this time, and I'll say it again, and put the hat on me. But this isn't a once in 50-year event going off the gold standard. This is one of those 1 in 400, 250-year events where there's a paradigm shift worldwide where people don't trust paper and they trust the metal. That's what I'm looking at. And if that's true, then you're going to have buying in all directions, and you are 100% correct. I don't care what the price is. I'm going to die financially if I don't have some gold.
According to monetary experts, the implications for markets are profound. Persistent official sector demand provides a powerful price floor that insulates gold from the speculative swings of private investors. Each period of crisis rewarded those who had prepared by accumulating hard assets. The gold price typically rises when Fed officials send mixed signals about future policy direction. Market uncertainty increases the appeal of precious metals as portfolio insurance. Recent data shows gold reached $3,500 per ounce in 2025, despite the Federal Reserve maintaining restrictive interest rates at 4.25% to 4.50%. This reflects growing concerns about Fed policy effectiveness. Renowned market experts Lobo Tiggre and DavidMorgan share their bullish insights on past gold cycles and its recent rally. Unlike the brief 1980 spike, this gold rally is a consolidation driven by massive central bank buying. After the US weaponized the dollar, Lobo notes that these players are now securing their reserves. This isn't a flash in the pan, it's a strategic global shift. Lobo Tiggre says this resilience isn't a fluke. As of mid-2025, central banks collectively hold nearly 36,700 tons of gold, representing about 27% of their total reserves. This is a remarkable milestone. For the first time since 1996, gold holdings have overtaken US Treasuries in official portfolios. While broader markets roll over, gold and silver are showing incredible resilience. Past shocks all failed to break the gold market, and this time, the floor is being held up by governments. Lobo Tiggre notes that what Michael Howell calls global liquidity and Lynn Alden calls fiscal dominance is creating an environment where monetary metals will inevitably rise. With no U.S. president willing to allow a recession, money printing is the ultimate driver of gold and silver. Historical patterns reveal consistent relationships between Federal Reserve decisions and precious metals performance. During quantitative easing programs, gold gained 50.6% as markets feared currency debasement from excessive money printing. Before we dive into Lobo Tiggre and DavidMorgan's sharp insights from their latest interview, be sure to hit the subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
This shows what I want to say, and I don't have control of your mouse, but where it's pointed right now, and the audience can see, there's this big ramp up to that big breakout there with the COVID pandemic and the lockdowns and they denied it until they were blue in the face. But anybody who was paying attention could see that the response was going to be inflationary. That inflation was, no surprise to anybody whose job wasn't to lie in public, I think. But anyway, so when that happened, there are all kinds of people saying, oh, this is 2011, 12 all over again. It's just gone up too much, too fast. It's got to crash back down. And guess what? It consolidated and made this other big move that we've now seen over the last year and a half. So you could say, okay, well, now this time's really it. But if you remember the chart that you started with, that peak on the right is actually sideways for months now. Mm-hmm. Yeah. Yep. This is not at all like 2011. It is not like 1980 either. If you were, no, sorry, my young brother, you're not going to remember 1980. I do. I was just a kid, but I was in the market. I was buying silver, not gold, with my lawnmower money, but I was in the market, and I remember 1980, and that peak lasted less than a day. That $855 peak lasted less than a day. And the $800 peak lasted less than a month. It was like $600 shoulders on that puppy. So what you're looking at here is really significant. And now this doesn't prove that gold's going to the moon or 10,000 tomorrow or any stuff like that. Don't put a clickbait headline on me, Daryl. But it does mean these people who are like, oh no, it's gone up too far, too fast. Therefore it has to correct. Well, they were wrong in 2000. They were wrong earlier this year. And I would caution anybody against believing anybody right now that says, oh, this is it. It's gone too fast. It has to break down. That is an insufficient argument. That would need to come to me with something like, what's changed? Why would it? And I don't know how far down this rabbit hole you want to go, but just real quickly, I think the central bank buying that started under Biden with the weaponization of the dollar in response to the second invasion of Ukraine, I think that's an absolute game changer. You don't just have deep-pocketed investors. You've got freaking sovereigns out there, the deepest pockets of them all, buying gold like there's no tomorrow, which... Given the geopolitical news, there might not be. Who knows? All I'm saying is this is a very different market than we've had in the past. It's very dangerous to assume, things that you've seen in the charts in the past must prove, therefore, what happens next. And given that new reality, given that game changer, I've been saying all year since we hit 3,500 the first time on the futures that, as peaky or toppy or whatever you want to call that as that seems, I just don't see a lot of downside risk. There's a huge pool of money that's a determined buyer in the space, and that has obviously changed the game. I would flip it slightly backwards. Instead of looking at the resistance, I've been looking at the floor around 3,300 plus or minus. And for something to go, look at this chart you've got on there right now. For somebody to go screaming up to 3,500 and then correct down to around 3,300, other things being as they were before, I probably would have been having, rotten tomatoes thrown at me and people saying I hate gold or I'm a fair weather friend or something, because I probably would have been saying, guys and gals, 3,500, that's a CPI adjusted all-time high. A correction here would be reasonable to expect. And it's made me really nervous all year long that I haven't been doing that. I'm usually the guy who gets booed for saying, look, hockey stick, it's time to take some profits here, right? I do always say you can't go broke taking profits. But I've been saying that, again, flipping it upside down, instead of looking at the resistance, I'm looking at that floor. And to me, it's striking that we have seen a lot of headlines all year long that until recently would have been very bearish for gold. Things that would, smack the gold around, whether it's, the flip-flops on the tariffs or whether it's the Fed doing this or not doing this. And every time that happens, we get a little drop, Daryl. Instead of saying, 3,500, that was the peak and now it's going down, it seems to hit a floor. And I think it's the central banks. Now, the central banks, they're not going to send it soaring super high. They're not trying to make it go higher, but they're not stupid. And if they see a sale price, then they're likely to take advantage of that. So I'm not expecting the central banks to send gold over $4,000 an ounce or whatever target you like. I'm expecting central banks to keep it from melting down too much, and that has stuck all year. I'm expecting inflation, chaos, geopolitical turmoil. I'm expecting those sorts of things to push monetary and safe haven assets upwards. So my bull case is not the central banks. The central banks is sort of my bear trap or my bear protection, if you will. The markets have rolled over as you and I are speaking. Gold's up $40 an ounce, silver's over 40 handle on silver. The broader indices have rolled over and they're all in the red. This could be it, Daryl. This could be the beginning of the next big slide. But it might not be. Every shock that we've seen, as you've just outlined, has failed to deliver that. And I see this as a sign of what, I don't know if you've interviewed Michael Howell, he calls global liquidity, or Lynn Alden, fiscal dominance, or my simple, humble wolf, I just see the money helicopters in the sky. But basically, trillions and trillions of dollars thrown at these things, and that has to have consequences. And it has clear consequences for monetary metals, but it's also inflationary, which has consequences basically for anything real, anything you can't print. So, it's an interesting thing. As bad as 2008 was, I remember Bush sent people stimmy checks and they're like $100 or $80 or something like that. Nothing like the thousands of dollars that we sent in response to the COVID lockdowns. And I don't want to get Trump fans mad at me, but whether you love Trump or hate Trump doesn't matter. Ask yourself, do you think this president of the United States is going to sit there and let a recession happen without ordering the money helicopters redouble their efforts? This just doesn't look like something that this president would do. He's making America great again. He's said on TV that we now have the hottest economy in the world. That's been his mantra for months. We got the hottest economy in the world. If anything starts looking not so hot, you think he's just going to sit on his hands? Of course not.
Contrary to traditional market expectations, rising bond yields are now supporting rather than suppressing gold prices, a significant shift from historical patterns that deserves close examination. For decades, conventional market wisdom held that higher bond yields were negative for gold prices as they increased the opportunity cost of holding non-yielding assets. However, the relationship between yields and gold appears to have fundamentally changed. A historic shift is underway, moving capital from paper assets to real money. While central banks started this move years ago, now institutional giants are quietly joining in. In this in-depth interview, DavidMorgan states that evidence suggests Saudi Arabia and Russia are creating a silver reserve. Given silver's tiny market, even modest demand from these players can spark massive moves. A major catalyst for silver's recent performance was the United States government's official designation of silver as a critical metal. This classification acknowledges silver's strategic importance to national security and economic stability. The recognition of silver as the second most versatile substance on Earth reflects its irreplaceable role across multiple industries. This is a once-in-a-century paradigm shift as confidence in paper assets collapses. DavidMorgan foresees a new phase where holding no gold will be seen as financially fatal. Let's get back to the interview.
Having said that, that's only a precursor to the overall maximum shift in ideology, which means going from basically trusting paper assets, which the safest asset is the United States Treasuries, T-bills, T-bonds, T-notes. Well, that's a false statement on surface. We all know the debt can't be paid back. So why would you buy, a business and the owner has a debt and you buy his business knowing that when you take over the business, you never have a chance to ever pay back what's owed, let alone make a profit? I mean, it's ridiculous. Of course, in the bond market, you make a profit playing the game of our interest rates going higher or lower, and then the bond price changes and you sell or buy the bond based on your bet. But that's even coming to, not to an end, but it's subsiding. So the shift is monumental. It's from things that I used to trust that I don't trust as much anymore. I won't say I don't trust it. I don't think it should be in bonds at all. That's my personal strong opinion. But moving out of bonds and moving into what you can trust, what have you trusted for 5,000 years before there's even been a bond market? Well, it's called gold. So you're seeing a shift by central banks moving out of the sacrosanct at one time U.S. debt into gold. And that started a couple of years ago. And I kept saying the run to gold has begun. And go back and verify that if you wish. And I'm not trying to pat myself on the back, just that, I've analyzed these markets for a long time. And sometimes people don't see the obvious. To me, it was quite obvious. And I kept pointing it out. But now it's going beyond the central banks. It's moving into larger money, hedge funds, family offices, pension funds, even saying, hey, wait a minute, our treasury is the most, the grounding force in my portfolio. And the answer is maybe not as much. Maybe we should hedge. Maybe we should buy some gold. So I think the trend, again, for this last phase has started and will continue. And as more and more of that shift goes from people where 1% say I'm shifting 2% to 3% to 5%, perhaps saying I've got to either hedge or I've got to lighten up my load on U.S. debt and move into gold and or silver, or gold and silver, or gold and platinum, or whatever, and perhaps the underlying ETFs and even perhaps the underlying mining shares, because there's several ways to get exposure. That shift is just starting. You're just seeing it. It's like the marathon has just started, and 1 mile out of the whatever it is, 28 is there. 2 miles have gone by. It's the banks only. Now we're moving to mile 3 to 4, and we're starting to see other participants. Now I've gotten some calls, and not many, but some on those type of entities, family offices, or I'd say not big hedge funds. I mean, those guys don't talk to me, but some smaller ones. And I think now that it's a critical mineral from the USGS, that gives impetus to the validity of silver. And then, of course, who's ahead of the pack? Well, Russia bought silver, whether it was for strategic reserves or for monetary purposes, really is immaterial. It was a purchase of silver for whatever purpose. And so they've kind of spearheaded it along with the Saudis, as you said. So yeah, we're starting to see it trickle in. What'll be interesting is it's such a small market. You don't need much more buying power to see it really move. And I just finished an article I'll be posting later today, probably on my Substack, on silver as a once upon a time strategic metal. I've gotten into conversations with some of the others in the field. I won't name them, but the United States actually started what's called the Silver Eagle program. The official title was Silver Liberty, but I'm a stickler for fact. But regardless, it was from the strategic stockpile, the defense holding of silver. And at that time, some of the senators thought, well, this silver is just lying around. We can get as much as we want, and who cares? Let's lower the debt. Let's get rid of some of this debt. Let's sell silver in the market. They came up with an act in 1985, started minting in 1986, and they were so short-sighted that the initial legislation said they could only use silver from the stockpile or domestically produced sources. Well, there's so little silver mining in the United States for decades that all of a sudden they had to change the law and said they could source silver from anywhere in the world to keep the Silver Eagle program going. So I did a pretty long article, pretty detailed, pretty fact only, not too much opinion in there. And I cited, I think, 5 sources. So anybody in the metals group that wants to push back on me can all they want. They're welcome to their opinion, but facts are facts. I cite them all. And so we did have silver as a strategic metal at one time. Not anymore. Critical metal does not equal strategic metal, although you can play the semantics game. But anyway, so thanks for bringing that out. And I think you made an excellent point that I think the silver move is just getting started. I mean, it's been behind gold, as we all know. Now seeing 40, people are getting excited. They have a right to get excited. But I'm really looking forward to that 50 mark and see what happens. And we really only been over 50 for very, very short amounts of time. So the seasonality on gold is pretty strong at the end of the year and usually into the first month of January. In fact, you can almost make money every time trading the other white meats, platinum, palladium, get a position in like early December and hold it through the end of January. Almost always make. I don't know why. I suspect that's when the users buy it, but I don't know. Anyway, back on point, Danny, somewhere we're going to need, and again, going back to what I said, I don't want to see it go parabolic here, and we're not even close psychologically to the Manic band, because at the point where you really, I think this time, and I'll say it again, and put the hat on me, but this isn't a once in 50-year event going off the gold standard. This is one of those 1 in 400 year, 250-year events where there's a paradigm shift worldwide where people don't trust paper and they trust the metal. That's what I'm looking at. And if that's true, then you're going to have buying in all directions, and you are 100% correct. I don't care what the price is. I'm going to die financially if I don't have some gold. That's the mindset. Does that mean that's the truth? No. The paper money may hold and it may, be undervalued or whatever. I don't see the dollar going away. I don't see it collapsing 100%. But the mindset could get to where I think that's going to happen, or it's a likelihood. I never thought it could ever happen, but now I'm giving it a 10% chance or whatever. Once you get in that manic panic phase, oh my goodness, if I don't have gold, I am done for. I can't afford gold. I'll buy silver. It's under $100. People will not use logic at all. They will use emotion, and they're going to say, if I can't feed my family, if I had gold, if I would have bought gold, 3 months ago, I wouldn't be facing this pay the groceries or pay the electrical bill. Gold has doubled since then. I'm not saying that's the exact case, but we do get an acceleration when we hit that manic panic phase. And it won't be, the Saudis and the Hunt brothers. It'll be a global phenomenon, in my opinion.
When confidence in the Federal Reserve weakens, 2 primary forces drive gold prices higher: changes in how markets perceive risk and increased demand for assets that safeguard wealth during uncertain times. Central banks are preparing for a world where the dollar's supremacy is no longer assured, where financial systems may fragment into regional blocks, and where tangible assets like gold reclaim a central role in international settlements. As institutions continue reallocating into gold and silver, do you see this as the early stages of a long-term monetary reset, or the final warning before the current financial system breaks? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.